Matt McCormick helps manage $4 billion in assets as a portfolio manager for Bahl Gaynor. He usually joins us from Cincinnati, but we're lucky enough to have him right here in our New York studio. Matt, good to have you here back on Street Smart.
Thanks for having me.
What do you make of today's rally?
I think you're looking at a relief rally where you had a number of days, Carol, where you were seeing some down sessions. IBM clearly drove positive earnings, and I think also the possibility of a negotiated settlement with the budget negotiations would be helpful for the market. I think I am a little bit worried about the negotiations. There's still a lot of details that need to be ironed out.
This isn't you turn on a switch and everything's fixed.
No, this is, you could see the sentiment right now and the lack of confidence. If you see any whiff of a settlement, you're seeing a market rally. I still feel there's a lot of details that need to be ironed out. I would caution investors to understand that volatility can work both ways.
You say also be realistic in this market environment. Expect single-digit returns.
Sure.
So don't get caught up in any kind of enthusiastic day.
Right. Even if you look at if there's a settlement in the budget negotiations, you still have the specter of Europe that is yet to be resolved. And does anybody really believe that Greece is going to be resolved favorably? I think when you look at what's happening here right now, you have an economy that is getting better, but it's still very tepid. You're looking at earnings that are getting better, but they're selective. And plus, you need to focus on what we feel is tepid earnings, specter of rising interest rates, inflation. We think dividend stocks are the way to play that.
Hey, I want to get to some earnings right now. Suzanne, we have Chipotle earnings crossing. Why don't you break those numbers down for us?
Yeah, Carol, the Mexican Grill actually missed on their profit numbers. The company earned $159. The street was expecting $167. A lot of anticipation for Chipotle because this is a stock that has gained nearly 60% this year. Same-store sales look pretty good. They're up about 10%, and revenues actually came in ahead of what analysts were expecting, $571 million, $560. So some weakness on the profit front. We're still looking through the numbers, but again, this could be a bit of a disappointment. That's why the stock is down 5% in the extended session. These restaurant companies, UBS recently talking about the restaurant group, and Chipotle actually was one of the stocks it was more bullish on because of its growth aspects. This is a company that went public in 2006. It was spun off from McDonald's. McDonald's, by the way, reports earnings on Friday, but clearly a bit of a disappointment for Chipotle Grill. And part of the reason is this stock has had such a tremendous run this year, as I mentioned, up 60%. So we're going to go through the numbers, see if there's anything that investors can latch onto that may be positive. But right now, a clear disappointment, Carol, from Chipotle.
And as you said, taking a hit in the after-hours trade. Matt, I don't know if you like Chipotle. I know you like McDonald's. Why McDonald's?
I like it because of its dividend yield. It's increased their dividend for 39 straight years. You have an average ticket of $5.62. Most Americans can afford to feed their families on that. You look at strong revenues, particularly from international, 60% revenues international, 20% in Asia. I think you also look at a yield that's roughly 2.9. It's on par with the Treasury note and the 10-year. And so I look at myself, I'd rather invest in McDonald's over the next 10 years than the 10-year note.
You like dividend players, but you say don't buy companies with big dividends.
I think we like dividend growth more than anything, because if you have a dividend and you pay it out, you can't fake it. And if you have consistent earnings that are rising, you can pay more every year. We like to give our clients raises. Who doesn't like a raise in this environment? Costs only seem to go up. And if you look at a company like Procter Gamble, it's increased their dividends 56 straight years. Emerson's 56 straight years.
So you don't care that Procter Gamble for the year is pretty much flat on the year. You don't care because you like what you're seeing in terms of the dividend story.
We look at it from a consumer staple. You look at it wants versus needs. You hope people will continue to.
Because look at Procter & Gamble. This chart's kind of all over the map.
Sure. But if you look over a longer period of time frame, when you look at periods like 2008, it actually has dividend growth and earnings growth. It may not absolutely perform on a day-to-day basis, but over a longer term, it's the quintessential blue chip consumer staple. It is a needs, not wants stock. And I think when you look at the dividend growth over 56 straight years, it's going to continue that over time. And if you have a strong dividend, your yield on cost gets much more better.
You know, Matt, as you well know, I mean, there's been periods where you can kind of buy anything in the market and you do well. But are we back to, we've heard this over and over again, that it's a stock picker's market?
Sure.
You've got to be very selective here.
I think that's a great point. When you look at what is a risk-on or risk-off trade, and in my opinion, we are clearly in a risk-off situation. You need to be very selective. You can't just buy the broad indices. We like high-quality dividend plays because when you look at blue chip companies, they have strong balance sheets, cash flows, and they're going to pay you more to own them.
Matt, I know you don't own Yahoo, but obviously you look at a lot of different companies and decide what to buy, what not to buy. Why not own Yahoo?
I can't really question why Yahoo needs to exist. When you look at the other vehicles out there, clearly they are beating them in whether it be revenue, whether it be earnings, whether it be ad or banner revenue. And I think when you look at the way that we like tech companies, I'd rather bet on something like Intel, which has zero debt and it's increased its dividend 31% this year. And I think we'd rather have the bricks and mortar of the tech space than involved with something that in some manners are discretionary purchases.
All right, and Intel, you've got up about 10% this year. Speaking of tech names, we talked a lot about Apple because we're waiting for their numbers out in about 20 minutes from now. Apple among your buy list or no?
We don't own it because it doesn't have a dividend.
Okay.
And I think when you look at Apple, it's a great machine. It's done great. The expectations are sky high. They have to continue to execute and exceed those expectations, or else you could see a sell-off in the stock.
Would you like to see Apple pay a dividend considering all the cash that they have? We talked about it earlier in the newsroom, that something about they generate about $70 a share in just cash.
I would love to see it. You know, you look at some companies like Cisco where they've traditionally not paid a dividend. You look at tech companies as a whole, they didn't, and now they are because they're realizing they're more mature. They have the cash flow, and you have investors say, I want more money right now because where else am I going to go? So I would love to see Apple pay a dividend.
So everybody you're playing with, Matt's got to have some kind of dividend exposure.
Absolutely. We think that's the key to the crucial key to total return. It represents so much of total return. And I think going forward right now, I would love to have a head start with a strong dividend yield considering the volatility in the market.
Digital Realty Trust is another one you like, paying out a dividend as well. This stock's had a great run, up 22%, or this real estate investment trust, I should say.
It has a 4.5 yield. It's involved with disaster recovery, the actually storage space for tech companies like Apple, like Yahoo, for hot or cloud computing, the actual warehouse space. 4.5 yield. It's a financial stock, but it trades like a tech company.
How easily are you find things to buy at this point? Or are you just adding to existing positions?
We're adding to existing positions, but we love high-quality dividend-paying stocks right now. We think with all the uncertainties, that gives you some downside protection.